Congratulations for completing Level 2 of the crash course. Welcome to Level 3 Lesson 1. My name is RIA the Trader from TradingWing.net. In this lesson, you will learn more about penny stocks and the influence of social media on those stocks. So let's get started. As mentioned in the previous lesson, free float is a critical term when it comes to trading. Free float represents the number of shares available to the general public. It is calculated by taking the number of outstanding shares and subtracting the number of institutionally owned shares from that value. To put it into simpler terms, you will take the total amount of shares and subtract those owned by executives and governments. The remaining amount is the free float. Free float is important as it affects volatility and stock price. When looking at free float, it is important to understand the concept of supply and demand and how that can affect the price. A low free float implies a lower supply. A low free float, on the other hand, does not imply a greater demand. For example, if we had a stock that had a free float of 1 million shares and the number of shares purchased was 100 shares, there is not a great demand. However, the supply is still low. On the other hand, if there is a free float of 1 million shares and the number of shares purchased was 800,000, the remaining free float would be 200,000. Therefore, there would be an even lower supply and a greater demand. This case will see a decrease of supply and an increase of demand. The term penny stocks and the term low float stocks are not exactly interchangeable. However, penny stocks are often low float stocks, and low float stocks are often penny stocks. The reason these types of stocks are very attractive to the everyday trader is due to the fact that low float stocks are often not held by brokers due to insufficient supply. Thus, short sellers do not have adequate access to borrowable shares and cannot really short the stock. This makes it difficult to create a balance of price change. In effect, this causes the price of the stock to drastically increase very quickly. When it comes to social media, penny stocks and low float stocks are a target for social media influencers and scammers. Why exactly is this the case? Social media influencers and scammers misinform new traders, causing an increase in demand and a decrease in supply. This will directly affect share price, causing it to rapidly increase and potentially halt. Again, halts will be mentioned in a later lesson. Halts will in turn bring in more traders and cause even greater increase in demand and decrease in supply. But how exactly are penny stocks and low float stocks considered a scam, or how can they be a scam? Social media influencers and scammers typically purchase a very large sum of shares in small quantities before announcing it to their followers. This guarantees them a lower priced entry. Once the price increases following the announcement, they proceed to sell all of their shares to individuals who are demanding shares. This is a process known as pump and dump. This leaves vulnerable traders stuck at a loss, making them bag holders for several months or several years. As a successful trader myself, here is my recommendation to you. For starters, avoid trading stocks under $5 per share until you are experienced and confident enough to do so. Once you gain that confidence and experience, stick to buying a small amount of shares in case of a pump and dump. My third recommendation is to do your own research before buying a stock. This should be the case for every single trade you make. However, in the case of penny stocks and low float stocks, this is critical. This is because social media influencers and scammers typically repost old news, posing it as new catalysts. My final recommendation is to not trade based on what social media influencers are saying. despite the fact that they may have hundreds of thousands of followers. Stick to your own due diligence. And that concludes this lesson.